Welcome to EcoBiz Academy, and welcome to the Complete Accounting course. I'm your host, and in this series we're going to work through financial accounting systematically, from the very foundations all the way through advanced accounting topics.
So we're not doing random accounting tips every week.
Absolutely not. We're building an actual course, chapter by chapter, concept by concept, example by example.
Because accounting is one of those subjects where missing the basics comes back to bother you later.
Exactly. And today we're starting with one of the foundations of the entire subject, the double-entry system.
Let's start right at the beginning. What exactly do we mean by double entry?
Double-entry bookkeeping is a system used to record the financial effects of business transactions. The key principle is simple. Every transaction has two accounting effects. One effect is recorded as a debit and the other as a credit.
So every transaction has two sides.
Exactly. And there's an important rule. The amount debited must equal the amount credited.
Every single time.
For a properly recorded double-entry transaction, yes, if we debit an account by $1,000, there must be a corresponding credit of $1,000. If we debit $5,000, we credit $5,000. That equality is fundamental.
Here's where students usually get nervous. Debit and credit. People hear those words and immediately start memorizing rules.
And that's where we want to be careful. Debit does not simply mean money coming in. Credit does not simply mean money going out. Those shortcuts can cause problems. In accounting, debit and credit identify the two sides of an account. The debit side is traditionally the left-hand side. The credit side is the right-hand side.
So debit and credit aren't automatically good or bad.
Correct. They're accounting terms. Don't attach everyday meanings to them. Think of an account as having two sides, debit, credit. And every transaction is analyzed to determine which side each affected account belongs on. Let's take a simple example. Suppose the owner started a business by putting $20,000 cash into it. What has happened?
The business has received $20,000 cash.
Correct. And what is the other effect?
The owner's capital in the business has increased.
Exactly. So we have two affected accounts, cash and capital. The accounting entry is debit cash, $20,000, credit capital, $20,000.
And the debit equals the credit.
Exactly. $20,000 on the debit side, $20,000 on the credit side.
Let's try another one. The business buys a computer for $3,000 cash.
Good. What has increased?
The computer equipment.
And what has decreased? Therefore, debit equipment, $3,000. Credit cash, $3,000. Notice what we're doing. We're not blindly memorizing an entry. We're asking, what changed? Equipment increased. Cash decreased. Then we determine the appropriate debit and credit. Now let's distinguish equipment from goods purchased for resale. Suppose a business purchases goods for resale for $2,500 cash.
The business receives the goods and pays cash. Debit purchases. Credit cash.
Correct. Debit purchases, $2,500. Credit cash, $2,500. Now let's change one thing. Suppose the business buys the $2,500 of goods on credit. What changes?
The business doesn't pay cash yet. Instead, it owes the supplier.
Exactly. So the entry becomes debit purchases, $2,500. Credit trade payables, $2,500.
So the second account depends on what happened in the transaction.
Yes. And that's why understanding the transaction is more useful than memorizing isolated rules.
Okay, let's reverse it. The business sells goods for $4,000 cash.
What comes into the business? and what has been earned.
Sales revenue.
So, debit cash, $4,000. Credit sales, $4,000. Now imagine the customer doesn't pay immediately. The business makes a credit sale of $4,000.
Then instead of cash increasing, the customer owes us money. So we debit trade receivables.
Exactly. Debit trade receivables, $4,000. Credit sales, $4,000. And notice something important. The sale is still credited. The difference is what happens on the debit side. Let's look at expenses. Suppose the business pays $600 rent in cash. What are the two effects?
Rent expense is incurred and cash decreases.
Therefore, debit rent expense, $600. Credit cash, $600. Now, suppose the business pays $300 for electricity through the bank.
Debit electricity expense. Credit bank.
Exactly. Debit electricity expense, $300. Credit bank, $300.
Can we pause here? Because I can see a pattern beginning to emerge.
That's exactly what should happen. At this stage, remember the broad pattern. Assets generally increase on the debit side. Expenses generally increase on the debit side. Capital, liabilities, and income generally increase on the credit side.
Where does all of this connect with the accounting equation?
Excellent question. The accounting equation is assets equals capital plus liabilities. Every transaction affects the accounting equation while keeping it balanced. For example, when the owner introduces $20,000 cash, assets increase by $20,000. Capital increases by $20,000. So, assets equals capital plus liabilities remains balanced.
And that's another reason the debit and credit totals need to agree.
Exactly. Double entry gives us a systematic way of recording the two-sided effects of transactions.
Someone might ask, why do we need all this? Why not simply keep a list saying, bought equipment, $3,000?
Because businesses don't have 5 transactions. They can have hundreds, thousands, or millions. We need a system that allows us to organize those transactions. We need to know, how much cash does the business have? How much do customers owe? How much does the business owe suppliers? How much revenue has been earned? How much has been spent on expenses? And eventually, we need this information to prepare financial statements. Double entry provides a foundation for doing that. Now, let's move into another important idea. A business may carry out many transactions of the same type. For example, imagine a business makes 20 cash sales during a week.
We wouldn't want to treat each transaction as some completely unrelated accounting event.
Exactly. Transactions of a similar nature are collected together in appropriate accounts. For example, sales transactions are recorded in the sales account. Cash transactions affecting cash are recorded in the cash account. Rent transactions are recorded in the rent account, and so on. This allows us to determine the total movement in each account.
And this brings us to the ledger.
Correct. A ledger is a collection of accounts. Each account records transactions relating to a particular item, person, source of income, expense, asset, liability, or capital. For example, cash account, bank account, sales account, purchases account, rent account, capital account, trade receivables, trade payables, and many others.
So the ledger is where the individual accounts are maintained.
Exactly. And traditionally, an account has 2 sides. Debit on the left, credit on the right. Before we go further, let's identify some broad categories. First, assets. These are resources controlled by the business. Examples include cash, bank balances, equipment, motor vehicles, inventory, trade receivables.
And assets generally increase on the debit side.
Correct. Next, liabilities. These are amounts owed by the business. For example, trade payables, loans, other amounts owed. Liabilities generally increase on the credit side. Then we have capital. This represents the owner's interest in the business. Capital generally increases on the credit side. Then income, such as sales revenue. Income generally increases on the credit side. And finally, expenses, such as rent, electricity, wages, and insurance. Expenses generally increase on the debit side.
Can we put everything together?
Absolutely. Let's imagine a new business called Greenar Traders. Transaction 1. The owner introduces $30,000 cash.
Debit cash $30,000. Credit capital $30,000.
Correct. Transaction 2. The business buys equipment for $5,000 cash.
Debit equipment $5,000. Credit cash $5,000.
Correct. Transaction 3. The business buys goods for resale for $8,000 on credit.
Debit purchases $8,000. Credit trade payables $8,000.
Correct. Transaction 4. The business sells goods for $6,000 cash.
Debit cash $6,000. Credit sales $6,000.
Correct. Transaction 5. The business pays rent of $1,000 cash.
Debit rent expense $1,000. Credit cash $1,000.
Exactly. And every one of those transactions has equal debit and credit amounts.
There's something I think students can easily get wrong. If a customer owes us money and then pays us, is that another sale?
Excellent. No, the sale happened when the goods were sold. If the customer bought them on credit, the business recorded debit trade receivables, credit sales, later when the customer pays, debit cash, credit trade receivables.
So the second transaction settles the amount owed.
Exactly. This distinction is extremely important. A receipt of cash does not automatically mean that income has just been earned. Whenever you see a transaction, follow 4 steps. What happened? Which accounts are affected? What changed? Which side should be debited or credited?
So understand the transaction before looking for the answer.
Exactly. Don't just memorize accounting. Understand it.
Let's test that. I'll give you a transaction and you give me the entry.
Let's go.
Owner introduces $10,000 by bank transfer.
Debit bank $10,000. Credit capital $10,000.
Equipment purchased for $2,000 cash.
Debit equipment $2,000. Credit cash $2,000.
Goods purchased for $3,500 on credit.
Debit purchases $3,500. Credit trade payables $3,500.
Credit sale of $5,000.
Debit trade receivables $5,000. Credit sales $5,000.
$2,000 received from a customer who owed money.
Debit cash $2,000. Credit trade receivables $2,000.
Wages of $900 paid.
Debit wages $900. Credit cash or bank $900.
But that's the logic we want to develop.
Before we finish, remember these common mistakes. Don't assume debit means money coming in. Don't assume credit means money going out. Don't record only one side of transaction. Don't confuse a credit sale with receiving cash. And most importantly, don't memorize entries without understanding the transaction.
Because when the question changes, memorization can fail.
Exactly. Understanding lasts longer. Let's recap. Double entry records the 2 financial effects of every transaction. Every transaction has a debit and a credit, and total debits must equal total credits. Debit is the left side. Credit is the right side. Assets and expenses generally increase with debits. Capital liabilities and income generally increase with credits.
And when analyzing a transaction,
Ask, what happened? Which accounts are affected? What changed? Then apply the debit and credit rules.
before moving on, try these 5 yourself. 1. Owner introduces $25,000 cash. 2. Furniture purchased for $4,000 cash. 3. Goods purchased for $6,000 on credit. 4. Goods sold for $3,000 on credit. 5. Rent of $500 paid in cash. Pause here and write the entries before checking.
1. Debit cash $25,000. Credit capital $25,000. 2. Debit furniture $4,000. Credit cash $4,000. 3. Debit purchases $6,000. Credit trade payables $6,000. 4. Debit trade receivables $3,000. Credit sales $3,000. 5. Debit rent $500. Credit cash $500.
And that's Chapter 1.
We've covered the double-entry system, debit and credit, ledger accounts, and the logic behind recording transactions. In the next chapter, we'll look at the books of prime entry and how transactions are first recorded. This is EcoBiz Academy.